Hi, good evening, everybody. Welcome to Endowus Live webinars. Today, we're really excited to be introducing a new solution for Endowus clients. Endowus is finally launching our Endowus Income Portfolios. We launched it as a soft launch for existing clients at the end of last year. Now we're ready to launch it to the world. So we're introducing the Endowus Income Portfolios today, and to introduce, my name is Sam Ree, and I'm the Chairman and Chief Investment Officer at Endowus. And with me today is my colleague Yu Lin.
Hi everyone, I'm Yuling, and I am the investment lead in Dallas.
Great. So we're going to jump right in, guys, with the disclaimer. And again, Slido poll to let you know that you can go into Slido and ask away with any question you would like. You can upvote the questions on the YouTube channel. You'll have right below the link. The event code is going to be on the top right of the panel, so you can see at any point in time. And the questions will be taken at the end of the session, and we'll do a Q&A session. But the early part will be a presentation. And just as a very quick introduction for many of you who may have joined us or are watching this YouTube later, wondering what Endowus is. So Endowus, for those who don't know, is a fee-only digital wealth platform. It's the leading digital advisory wealth platform in Asia, and one of the fastest growing. Our claim to fame is that you are able to manage your total wealth on a single app across all of your monies. So cash savings, your CPF, and your SRS. We are the first and only digital advisor for CPF investing, and we built an end-to-end tech stack that allows you seamless onboarding, investments, and management of your wealth. We're backed by global strategic and venture shareholders. SoftBank, Lightspeed are two of the biggest venture investors in the world, but established brands like UBS, the biggest private bank in the world, Samsung, the biggest technology company in Asia, Singtel, the biggest innovation company in Singapore alone. But also we're backed by EDBI, the global investment arm of Economic Development Board here in Singapore. Prosus, which many people may not know, is the biggest shareholder of Tencent and Ctrip, and also companies like Delivery Hero, which owns Foodpanda. Z Holdings is a SoftBank and a Naver of Korea joint venture that owns the Line app and has digital presence across the whole region. So we're really excited about our investors and minority investors. We also just won again our FinTech Innovation and Asset Management Award, joining a lot of our fund management company partners in being recognized as the innovator in the wealth management and asset management space. We were the Wealth Tech of the Year award last year. And so we're really excited about the recognition that we're gaining from the industry. But the most important recognition is that of our clients. And it's really exciting that we are able to launch this income portfolio because we've really listened to our clients. They've told us they would like an income portfolio. We didn't want to build just another income fund that's similar to what's out in the market. So we really thought hard, listened well, and have finally delivered a product that we can be proud of. So we're introducing the all-new Endowus Income Portfolio. If you go into our investment app or the web app on your computer and you go log in, as a first-time investor, we always say that the first portfolio of choice for most clients will be the core portfolios. So looking at the core and satellite strategy, core investing is really important. It's the anchor in especially times of volatility. And it's the portfolio that you can manage your cash saving, CPF, SRS holistically in one place. We have two choices: the flagship portfolio for core, which is a globally broadly diversified, low-cost investment solution. But we also have ESG sustainable investing, which is the first of its kind in the industry, where retail investors access institutional quality ESG portfolio across the whole risk spectrum with multi-manager solutions. And we're focusing today on income, the bottom left. So that's a new logo that has appeared for investors. so passive income portfolios. And we decided we're not going to just launch one, but three different income portfolios, and we'll explain why. But before we go on, I want to explain what is income investing for those who are curious but don't know and haven't really looked into income investing. It's a very popular investing methodology here in Singapore and across Asia. Why do we do income investing? Because we want to focus on that income part of the investing piece. So we want to supplement our monthly income either from our salaries or from our savings. But when we invest in a portfolio for savings and then take passive distributed cash flow on a monthly or a regular basis, some are quarterly, then we can supplement our daily expenses, our financial obligations, maybe fund our hobbies or desires and wants and needs. So that supplemental income is very, very handy. The second thing is we seek shelter on rainy days. There are times when our income may fall short or our income is cut off. Having this pot of savings that is going to constantly give us a passive income stream is a source of comfort for us. In a volatile market, in a difficult financial situation, it could be the difference between safety and security and a lot of stress and grief. Finally, strengthening your portfolio. So it's a form of diversification in your portfolio because income assets inherently have slightly different risk characteristics. It sometimes has low correlation versus traditional equities and fixed income products. And so some of them have higher quality bias as well. So I think for many of these characteristics, there are personal preferences that supplement or complement an existing strategy like a core satellite strategy with an income portfolio. What's the key difference between regular investing, which is often termed growth investing, versus income investing? The purpose of income investing is really to prioritize what's called current income, the payout. And on a basis of, let's say, 100,000 invested and a 5% or around 5% payout ratio, you would receive about $420 a month. And the purpose is that this money will be spent, will be taken out of my investment and will be spent. You can have a capital growth component to it. So you still grow your portfolio a little bit, but the purpose is to really grow capital so that you can take some out, but preserve capital. So those are the three main areas that you want to target. Whereas growth investing is really about maximizing the long-term wealth and your saving. So the point is to grow your capital as opposed to the current income. And so some people may have some current income or distribution coming out from their investments. But what would normally happen is we reinvest that money. The $100 that comes out from that investment, we can reinvest it and continue to compound the growth of our wealth so that, like, for example, here after 5 years, you keep taking money out. And so you end up with 105,000. You've taken all this money out and you still have more than your base capital that you've invested. So it's great. But if you just kept it and reinvested, then the compounding of returns means that it's more than the sum of all the payouts that you would have received if you had income invested. So growth investing is really about different goals and different risk appetites and different needs. There are very many popular income products out there in the market that the Singaporean investment community are very familiar with. So in the public markets, there are dividend stocks in equities, there's REITs. In the fixed income space, there are single bonds that you can invest in. There are also income funds. So a single fund manager could invest and build an income fund for you. And then there are insurance-linked products and annuity plans that are often sold by insurance companies as well. A lot of these products are very common here in Singapore, and some people, individuals, mix and match. Some people know some of them and use some of them, others don't and use others. But here's a good summary for our investor base and anybody who's interested to compare, the pros and cons, because every investment has, some good aspects to it that we could commend. But there are also a lot of concerns or risks that we should be very well aware of. So it's really important to weigh the pros versus the cons that exist for each of this product. Some of the cons that I will highlight, because I think often people know very well the pros for each of these investment opportunities. So for dividend stocks and REITs, no matter what we talk about how stable the dividends and payouts and yields are, and there are potential for even capital gains over the long term, it is underlying a stock market publicly listed product. And therefore, it's exposed to the market moves, which are called market beta. And also, because you're investing a single stock or a single REIT, it is a concentration risk. So if you choose the wrong ones, then obviously you will have much worse than expected returns. Single bonds, likewise, the same thing for fixed income. High capital outlay. Oftentimes, unlike stocks, you can't even invest in single bonds unless you have a significant amount of capital, and you have to invest a meaningful amount into a single bond. Often, banks will tell you to leverage on top of that, which increases the risk kind of bucket of the single bonds. Annuity plans and insurance-linked products are fundamentally really, really expensive and costly products. It's not very transparent most of the times, but you can see if you delve into it that the fee structure is very, very high. And in a way, many of these products are the worst of both worlds. It doesn't give you the kind of returns that investments provide, and it doesn't give you the coverage that insurance should be providing as well. But most importantly, we all want some flexibility. Everybody has different circumstances and needs, and our life situation may change, but it's locked up. And therefore, if you try to redeem it, then there's a massive penalty oftentimes. And income funds are great, but there is a single manager risk. And therefore, you have to know the fund manager, look at the track record, and do proper due diligence. And oftentimes the funds have retail share class structures, which are really, really high fees. Now, Endowus is building a portfolio that will be a fund-to-fund structure with multiple income funds from some of the best fund managers, and also we'll be reducing the fees. So we'll go into that in a bit more detail. How did we approach building this Endowus Income portfolio? First of all, before we built it, we listened. So we asked all of our customers, and many of them responded very quickly and well. And what are the most important things? What are the most important features of an income investment? Starting from ground zero, looking at the first principles of how we should build an income portfolio for our clients. The number one demand was that let's preserve principal investment amount. Many products, including annuity products and other products, delve into the invested capital. And sometimes you're saving money and then you're pulling out your own money every month. So it goes down every month, but it's your own money that you're paying yourself. So the investment product is not doing its job of building wealth and taking from the gains. It's actually taking money from the principal. By the end of a long cycle, you may actually run out of money. So preservation of capital is really important. Secondly, fees. There's way too many fees across the industry. Lower the fees, and that's what Endowus does. Thirdly, target both yield and capital appreciation. So many people wanted a 4 to 5% average yield. Some wanted more, some wanted less. But there was an average yield that people were happy to target. But also many investors said, how can we build capital so that in the future that yield would generate more returns? And then the final thing, obviously, they suffered from redeeming insurance-linked products or annuity products because their circumstances changed. And therefore they wanted more flexibility and they didn't want to lock up. So what is the Endowus income investing portfolio really focused on? Firstly, it's a tailored product for your needs. Stable payout or a higher payout, or focus on capital preservation or capital appreciation. The choice is yours. We built 3 portfolios that it could be perfectly suited for your personal needs. Secondly, an all-weather approach. We built in resiliency in mind to manage risk through market volatility and the changing macro environment so that your capital is protected and you have the highest chance of success. Thirdly, we worked with some of the best global fund managers who are diversified investors, multi-asset. So this multi-manager approach is very unique, and it pervades everything that Endowus builds. All of our portfolios tend to be multi-manager. There are exceptions. There's one launching very soon, which will be maybe single manager. But the multi-manager approach is a great way to diversify risk. and to give you access to some of the best products that previously may not have been available. And we work with these fund managers to access institutional share classes, or as we promise, 100% trailer fee rebate so that you can achieve the lowest cost. And most importantly, invest any amount at any time with no lockups so that you're not beholden to the investment product and or suffer when you have to exit. So what are these three products? We've put this nice stick pictures to graphically describe exactly what we're trying to portray. The first product is a stable income product. It's great for retirees or people who don't have any income or who are expecting to have soon income that will decline, and therefore they have to rely on this investment to supplement their income or really pay for their monthly needs. Or it could be those people who are younger, but who have lower risk threshold. So they want something much more stable, and they have a need for a regular passive income stream. So a steady monthly stream of a certain amount of money based on how much you invested gives you a monthly regular payout and gives you tremendous visibility and transparency to plan out your life. And therefore, a 4 to 5% current payout target was created just as our clients had asked for us. Really focused on capital preservation so that the principal investment amount is not dipped into in any meaningful way. During times of volatility, there is a risk that short term we will see some negative returns because of the mark-to-market nature. But income investing by definition has to be long term. You have to put in the pot of money, add to it, and hold on to it for the long term in order to get the payout. And therefore, the long-term nature allows us to ride out volatility and enjoy the consistent payouts and cash flow that this product provides. Higher income was created for an earlier stage of your life, working adults with a higher living expense and a family to support. The sandwich generation who are supporting their grandpa, grandma. The picture on the left seems like a very young grandma, grandpa, but you have your parents that you have to support, your children are coming up, you have very high monthly spend needs, and you're still young enough to see opportunities for growth of your capital, so you can stomach some volatility. So we proposed a product that has a higher current payout. So for the same amount of money, you're able to take out a higher amount on a monthly basis of current payout. But it also comes with it slightly higher risk. The way we've achieved those higher payouts is taking a little bit more risk within the fixed income space, first of all. So we get exposed to higher yielding segments of the fixed income market. And this younger generation can accept some volatility because they still have maybe 10, 20, 30 years until retirement. And at the same time, we give you a little bit of exposure to equities. A 20% exposure to equities to build growth, but mostly in dividend and high quality equities. So this dual source of income from fixed income and equities allows diversification, reduces volatility, and achieves moderate growth of your wealth because you still have some time until your retirement to build and grow your wealth and increase the future payout of your monthly distribution. And the third product of the life stage income funds is one for the younger generation, working adults, or the young at heart who have higher risk tolerance and able to stomach the higher equity allocation. And the whole point of this is that, yes, some income would be great right now to supplement my hobbies or, for my, car allowance every month or other allowances. But what you want to still do is to grow your wealth. Because you have a lot of time ahead of you, many decades. So the current payout ratio has been cut slightly to about 3 to 4%. We've increased the equity allocation to about 40% and created a multi-asset diversified source across the whole quality and risk spectrum to achieve both a decent payout and a higher growth to fund your life goals. So the three products laid side by side have very distinct differentiation. What is your primary objective and secondary objective, whether you're achieving capital preservation mostly or trying to grow your capital a little bit, what is the current payout and the estimated long-term capital appreciation. All of these products can achieve negative returns in the short term, But as we highlighted again, income products should not be focused on the capital in the short term, but really long-term returns over decades to achieve the consistent payout and also the long-term capital appreciation that is expected from the portfolio. This one is a slightly more detailed slide showing you the asset allocation, where we've focused in the fixed income space. So the stable income by nature, higher quality, stable income distributing only, the higher income achieving higher yielding fixed income allocation, and the future income being a much more broadly diversified exposure in fixed income. But for equities, similarly, high dividend, high quality. Future income has a little bit more exposure in core passive kind of investment into the equities market, whereas higher income is really focused on paying out equities, dividends, and real asset funds as well. How are the Endowus Income Portfolios different? First of all, the Endowus Investment Office has worked really, really hard to build these income portfolios from ideation, from receiving feedback from clients, from building and selecting the funds that are out there and proper due diligence. We select the best-in-class funds from all of the available options, whether they're available here in Singapore or not. We would look at the global universe first, and then select from there. And then we'll work with our fund managers to bring in the right portfolio, select the best-in-class funds, design and construct the portfolios to achieve the three outcomes and goals that we have designed. And then we will have an ongoing monitoring of the fund performance, optimization, rebalancing, and decide on necessary portfolio changes in the future. So I'm going to hand over to you, Lynn, to go into a little bit more detail on the fund due diligence process.
Yeah, thanks, Sam. And just wanted to reiterate, Sam, on the robust and institutional framework-based investment process that we have. And we are a multi-manager. We use a multi-manager model, and we are at a unique position of doing this because we're not tied to any single manager, and we are only paid by you, and we are independent in that sense. So we not only have the framework, we also have the expertise to do it well in terms of the due diligence process, especially when it comes to income investing, because different income funds, they actually have their own quirks and specifics. So it is really important for us to understand it and do our research. And there are at least three things that we look at throughout our due diligence process. So firstly, on the capability of the investment manager, whether we have the conviction after the thorough research that they have the capacity and the right team and process to deliver consistent investment performance as well as income, as this is a primary objective of the strategies that they manage. And also another very important part is the consistency and actually sustainability of the income payouts. So this requires us to understand the distribution structure of the fund, whether what are the sources of income that they are paying out, whether they're actually dipping into the capital, which is something that we really, really don't want to see. And whether the current yield of the fund, for example, is able to sustain the desired target payout of the fund. And lastly, as Sam has already emphasized over and over again, and that is the cost of the product. And actually, we actively work and negotiate with fund managers to bring you access to the lowest cost share class possible. So we would do our best to provide you with institutional share classes of the funds. And if not, we actually rebate all the trailer fees that usually, the distributors keep for themselves, but we don't, and we rebate every single cent back to you. Let's move on to the next slide. So there are a lot of options on the market in terms of the asset classes that actually generate different levels of income. And when we combine these different asset classes, of course, one important thing is we always want to diversify the income streams so that we improve the resilience of income. And also, it is important to understand the trade-offs between the risk and yield of different asset classes, so that the portfolio construction can be done in a way that meets the different income and growth objectives of the three different products. And just briefly touch upon this chart, as you can see, actually the bond fixed income, they are relatively lower risk than equities. And within fixed income, there are different levels of payout. And the higher risk you take within fixed income, such as corporate bonds and moving upwards emerging markets bonds, the higher yield that you can get. And once you move over to the equity side, they actually do offer a lower yield, but because you're taking a higher risk, the capital growth potential for these asset classes is much, much higher. So the next slide offers us a look. Sam, can we move to the next slide? Thank you. The next slide offers us a look at the current income environment. And as I mentioned, sustainability of income is extremely important consideration for us. And income currently actually is not that easy to get income. If you saw a product that says and they offer you 8% annual payout, I think you probably need to reconsider and look into the product a little bit more and see how they are paying that 8%. So if you look at the yield across different fixed income sectors and even equity sectors, the highest yielding market currently is in Asian high yield, as we all know, because of the recent saga in the property sector that has really depressed the price and artificially improved the yield. And even that is only paying about 5.8% currently. And if we move to the government bond, it's only paying about less than 2%. So moving on, the trade-off, as I have mentioned, is really if you're taking a higher payout, you have to take higher risk, and there will be less capital growth. And that is exactly what we take into account when we design the portfolios. And we are very transparent here. We will tell you, what kind of risk that you are taking in different portfolios and what kind of capital appreciation profile you will get consequently. So we will go into that in a bit more details later on in the deep dive section. But before that, I will just hand over to Sam first.
Great, thank you, Lynn. And just want to highlight how the partnership with the world leading fund managers, the many names that are very familiar names for you, AllianceBernstein, Allianz, Aberdeen, that's a new logo and a new name from Aberdeen Standard Life, BlackRock, the biggest fund manager in the world, Columbia Threadneedle, Dimensional, Core Strategic Partners, Fidelity, First Sentier, who changed their name from First State, JP Morgan Asset Management, Neuberger Berman, PIMCO, and Schroders. These are names that you're very familiar with, and we have worked with them to build the income portfolios that uses the best-in-class funds that they have. As you can see, it's a selection of fixed income and equities, and according to the product, stable income, which is 100% fixed income, higher income, which is a mix of fixed income and equities, 20% allocation, and future income, which is a 60% fixed income and 40% equities. You can see the exact breakdown transparently. We provide all these details as you onboard, as you invest into these portfolios, giving you rationales behind why these funds were chosen. You can go into analytics on the investment fund list if you would like. And also transparently, most importantly, show you the total expense ratio. It's not the annual management fee of the fund, it's the total expense ratio. So the total cost of investing in that fund. Many advisors and platforms hide some of this and only show you management fees, but this is the total expense. And the trailer fee rebates that we have negotiated with these fund managers, which 100% goes back to you to achieve a lower net TER. So the point that I want to make is that, look, this is a multi-manager portfolio for each product. So working with the best in class for income funds, emerging market income, high yield funds, dividend funds, and core equity funds, Also I want to highlight the BlackRock Real Asset Securities, which invest in infrastructure and real estate to achieve a higher yield as well. So these products are wonderful products that we have selected and optimized. Some of them brought into Singapore, all of them at the lowest cost possible. And this is a comparison of how much savings you are able to achieve. So if you were using a retail platform, a bank, or a fund platform like iFast, Fund Supermart, or DollarDex, or Poems, or brokers, and other banks or private banks, whichever ones you use, they normally would provide you with a retail share class fund with a net TER that is significantly higher. What we do is a TER that starts at a lower portion because some of these funds we access the institutional share class that don't are not normally offered at banks and these fund platforms. So first of all, we access funds that were not readily available, and then secondly, for the retail funds that some of these funds are, and because they don't have institutional clean share classes, we would get the trailer fee rebate. And if you combine both of those combination and look at the total savings that each of these portfolios would provide for you versus what you would have been paying in a retail product, it's a significant amount. So it ranges, it's 0.57 percentage points, almost half of your investment on the stable income side, a little less in higher income, but the total fees are slightly higher there anyway, and future income, something in between. So the savings are quite significant, and this is one of the major reasons why you should be using the Endowus platform, not just for income portfolios, but for all of your portfolios, core, satellite, ESG, satellite portfolios, but also FundSmart, where we have single fund access at the lowest cost available here in Singapore for more than 95% of the funds on the platform. So understanding the key difference between, let's say, an annuity product, which is a very popular product that is very similar in concept. The key difference here, I would like to really highlight. I don't want to dwell on it too much, and these will all be in the insights articles and other publications. But really, the most important thing is that the costs are significantly different. So I touched upon the trailer fees, but annuity products are notorious for having embedded expense ratios, including trailer fees that are hidden and taken out of the NAV of the funds or the underlying products. Also, sales charges or other types of, custody fees and other brokerage fees and transaction fees and penalties, which are embedded. So costs are very high for insurance products and annuity products in general. Second thing is this payout structure. They do take out more from capital over time. So annuity product oftentimes is declining in value. The third thing is obviously the early withdrawal penalties, and the surrender period value is much, much less with significant charges. So there's a massive penalty for redeeming or taking your money out. And we all know that our personal circumstances can change. So having the ability to take that money out at any time and not being locked up is a really, really important aspect of the income portfolio versus other insurance products. I'll hand over to you, Lynn, for a deeper dive into the portfolios.
Yeah, thank you, Sam. I was seeing a lot of questions on Slido on the underlying allocations of different portfolios and the performance. So now we will go into that in a lot more details. And here is a chart for the historical performance and risk of the three portfolios, as well as the asset class benchmarks. That is proxied by the Bloomberg Global Barclays aggregate and MSCI Equity Index for the equities component. And just a few things to highlight. As you can see, over the longer period of time, the performance of the three portfolios are roughly in line with the benchmark, highlighting the diversification of the portfolio. And comparing, and because and the portfolio's risk is slightly higher than the benchmarks, and the reason for that is because the Bloomberg Global Aggregate Index inherently has a lot more allocation to government bonds. But the yield is literally very, very low. So in order to have the income objective realized for the three income portfolios, they do have a higher allocation on the fixed income side to corporate bonds, which has higher volatility compared to government bonds. But to compare between the three portfolios, we see that the return potential increases from stable income to higher income to future income. And that is underpinned by the asset allocation. Stable income is 100% fixed income, higher income mixes in 20% equities, and future income mixes in 40% of equities. And one thing to highlight, or one thing that you might find interesting, is that the risk between the historical risk data between higher income and future income look almost on par to each other. And again, this is actually a pretty important trade-off that we had to make in order to realize the income and growth objectives. So the higher current income focus of higher income portfolio mandates that the portfolio allocates to higher yielding fixed income sectors, such as high yield, that have higher credit risk, and they are more equity-like in terms of their volatility and max drawdown. And this is why you are seeing such risk statistics. And moving on to stable income. Sam, next slide, please. Thanks. So stable income is a 100% fixed income portfolio, and it is designed to offer stability with the current payout target of 4 to 5% and very limited or no capital appreciation at all. And it allocates to 4 high-quality fixed income funds. All of them are investment grade, and the duration of the portfolio currently is about 3.8 years. It was a deliberate choice to keep the duration and therefore the interest rate sensitivity of the portfolio relatively low. And moving on to look at the asset allocation breakdown. As you can see, 70% of the portfolio is in investment grade, with the remaining in high yield. And the portfolio does have a significant allocation to government bonds as well, and also securitized assets. The portfolio has geographically an overweight to Asia and emerging markets, and the reason is because keeping the credit quality constant, Asian bonds, they do offer attractive yield pickup compared to the global market and the US market. And I think just want to highlight, yes, we can move on. So just want to highlight the historical stability of the distribution. Historically, the portfolio has delivered really consistent payouts, both in terms of dollar amount, which is the blue line, as well as the annualized payout yield. The yield is basically just the dollar amount divided by the price of the portfolio. So of course, you see there are some minor fluctuations, and both are not completely fixed because the fund managers, they constantly assess the market environment and decide whether the payout targets that they have set is still suitable and achievable under the prevailing market environment. But we don't expect revisions to be frequent at all. And even we see the historical data, even during the March 2020 drawdown, although there were some loss of capital temporarily, the funds, all of the funds were still able to pay the expected payout. And that was a pretty impressive thing to do. Moving on. So yeah, this is just to show you the underlying payout structure of each fund, and that actually underpins the stability of the portfolio. So 3 out of the 4 funds, they offer fixed dollar distribution on a monthly basis, subject to regular review by the fund managers. And for Neuberger Berman's fund, although they don't pay a fixed amount in terms of dollar amount, the distribution is smoothed out month to month so that there won't be large fluctuations. And the next slide shows us the capital. The next slide shows us the capital appreciation of the portfolio as well as its underlying funds. And overall, we can see that the portfolio has managed to keep a pretty stable capital over the past 3 to 5 years. Of course, it's in a shorter period of time, the portfolio's value have dropped below the originally invested amount. And there were 3 periods to be precise. And that could offer us some insights into where we are now, actually. So the first period was 2017 to 2018, and that was actually a Fed tightening cycle, which is something that I think a lot of investors are worried about now. And that did have mark-to-market impact on NAV of the portfolio. Although the portfolio was still able to distribute 4% fixed income, fixed payout, and that makes up for the total return. But in terms of NAV, it did go below, and then it recovered. And then the second period was the 2020 March period, and that was a sharp drawdown in terms of NAV, and later on it recovered. So the most recent period is actually towards the end of 2021 until year to date, because of the Fed tapering concerns and concerns on inflation, as well as with the volatility in the Asian fixed income market. So it is important for us to understand that these market events, they do affect the portfolio in a shorter period of time, and they may cause temporary loss of capital. But as Sam mentioned before, the portfolios are really meant to be held for the long term, so that the short-term market volatility would not affect the long-term goal that you are achieving. Now let's take a look at higher income. Just to quickly highlight, it allocates to 8 funds, 5 of which are fixed income funds and 3 of which are equity funds. And the split is 80% and 20%. And there are some high yield allocation here. So actually 25% of the total portfolio is allocated to Allianz and Threadneedle high yield funds. And the portfolio is still short duration in nature. It's slightly longer than the stable income portfolio, but it's still significantly shorter than, say, a global core fixed income portfolio, which usually has a duration of 7 to 8 years. Now, let's look at the portfolio asset allocation. So as you can see that the portfolio has a significantly larger allocation to high yield compared to stable income. High yield is about 50% of the portfolio, and it also has some allocation to emerging markets, bonds, and some securitized exposure. And on the equity side, the portfolio allocates to high dividend generating income equity markets. So consequently, geographically, it does have a bias towards Asia and Europe, as well as real estate and infrastructure sectors sectorally. And those sectors and countries, they do offer higher dividend payout compared to the global market. Now let's take a look at the historical payout of this portfolio. And again, it's relatively stable, and the numbers are not completely fixed as usual. And let's take a look in the next slide on the payout schedule of the funds. And 6 out of the 8 funds, they offer fixed dollar distribution on a monthly basis, subject to regular review by the fund managers, of course. And for Neuberger Berman, as explained before, it pays smooth percentage payout. And the only exception here is the BlackRock Global Real Asset Securities Fund. So it pays gross income received on a monthly basis, and there is no smoothing at all. But it was very necessary for us to include this allocation because of its attractive distribution level. So it aims to distribute a minimum of 6% per year. And on average, actually, it has distributed 8% since its inception on average. So, and its allocation in the fund, in the portfolio is only 6%. So we only have 6% allocation to this fund in the higher income portfolio. So it won't, this fluctuation in this single fund's payout will not affect the overall portfolio very much. Now let's again take a look at the capital appreciation of this portfolio. It has a relatively shorter history than stable income because of the later common inception dates of the funds, but it's still worth taking a look. And as you can see, during March COVID, during the March 2020 sell-off, it dipped. The NAV had a dip, and then it recovered quickly. And you can also see that the 3 higher lines on this chart actually are the capital appreciation of the 3 equity portfolios. So we do expect that with the allocation to these equity funds over a longer period of time, the portfolio will be able to deliver a moderate capital appreciation driven by the allocation to these equity funds. Finally, moving on to the future income portfolio, which I personally think is a very unique product because of its dual objective of both income and growth. And for this portfolio, it allocates to 9 funds. So in a sense, it's probably the most complicated product. And 4 of the 9 funds are fixed income funds, and 5 of them are equity funds. So on the fixed income side, again, the emphasis is actually mostly on investment grade funds with only 5% allocation to high yield fund. And on the equity side, the portfolio allocates to both dividend focused funds and accumulating funds. So the accumulating funds are there to aid the long-term growth objective for this portfolio. And the portfolio's duration is actually the lowest amongst the 3 for now. So it has 2.9 years as of end of December duration exposure. And now let's take a look at the next slide. Sam, if you can flip over, thanks. So I put this first because there is something I want to highlight here. So 5 out of, again, most of the funds here, 5 out of the 7 distributing funds here pay fixed amounts monthly, subject to the review of fund managers. But there is one fund, which is the first Sentia Dividend Advantage Fund, that pays out quarterly distribution. And the amount is based on a fixed target yield, which is 4% per year. And again, the Neuberger Berman is also here, and it pays smooth percentage. So what this means to the historical payout and yield of this portfolio is that if we move on to the next slide, yeah, we will see that there is the overall payout of the portfolio is still consistent with the steady monthly distribution overall, but a spike every quarter when the payout of the first Sentia Dividend Advantage Fund is received. But this is if you annualize it, actually every year you should be able to receive consistent payout despite the quarterly spikes. And lastly, this presents the historical capital appreciation of the portfolio, and you can see over the long term, I think this is from 2017 to end of 2021, this portfolio did, despite the short-term volatility as well as the 2020 March drawdown, it did realize a pretty nice capital appreciation, just as what it is designed to deliver. Okay, lastly, we just put together everything so that you can compare and understand the objectives as well as the risks of the portfolio and understand the trade-offs between the 3 different portfolios. And with that,
yeah. Just on this slide, I think the trade-off between risk and return is really important for everybody to understand. And we've given you some data here that you can go into in more detail. So we have 2 data. One is the 12-month rolling worst outcome. So if you just capture 12 months period over every day, every month, and see what is the worst outcome over a 12-month period for the stable income and higher income period for products, then you can see that in 2008, during the financial crisis, the stable income portfolio would have fallen 12%, higher income 25%, future income slightly less, 24.45%. In March, it would have been about 3.18%, minus 6%, and minus 6.7%. These numbers are significantly better than the market returns, whether it's fixed income and equities. So there is slightly better protection on the downside for the investments. This max drawdown is a peak to trough fall period during 2020, during different types of periods where the markets fell, for example, 30% from the peak to trough for equities, and a lot of fixed income fell by 20%, 15, 10 to 15, 20%. So the worst outcomes are these, and the historical volatility is commensurate with the risk that you're taking. So stable income is lower volatility. As you take on more risk, you increase the equity portion, the volatility increases because of the asset allocation that we have towards equities, but also within fixed income, you're taking higher risk in the higher income segment. What's important to note through all of this is that, yes, in the short term, during market dislocations, when markets are falling, whether it's equities or fixed income, these portfolios are not completely immune to what the markets are doing. So they will move with the markets. The point here is that the purpose of the income fund is to generate current payout. Does the current payout get affected by these market movements? To a certain degree, there is a little bit of an impact, but largely the payout ratio and the payout dollar amount, especially when it's fixed, is something that will keep a stable income source for you despite what markets are doing. Finally, I would like to point out that over a longer period of time, this is the worst case outcome during a peak to trough fall or during a massive recession globally or locally. But over time, we know already since 2008 that the markets have gone up multiple times since 2008 lows. Even from 2007 highs, we have broken above those highs. 2020 March, same thing. Despite the COVID shock, the markets had rebounded very sharply and recovered. Fixed income recovered first, but also equities recovered and went on to create new highs and generate good returns for investors. So if you are a long-term investor, this short-term volatility is exactly that, volatility in a long-term portfolio. So you have to understand what are the risks, what are potentially headline numbers that will maybe frighten you. And that's why it's important to assess your risk appetite and your risk threshold to choose the product that is suitable for you. For example, stable income may not fall more than 15%, whereas for higher income and future income, you may see a bigger fall in the worst outcome. Are we going to see something like 2008 or 2020 March COVID? Maybe not. But we want to be transparent in displaying all the worst outcomes, historical numbers, so that you can make an informed decision about what the risks are, what are the potential upside, how it affects your payout as an income product, and how it will grow capital over the long term. So with that, we'll wrap up and move to Q&A. So we're going to look at the Slido polls, and our very friendly client advisor team have been rapidly responding to many of the questions that are in there. One of the first questions that I see is a comparison with Money Owl's Wise Income. So it's not very polite or nice to be comparing products with our competitors or friendly competitors, because Money Owl, we have tremendous respect and we love the team over there. But there is a difference. So I'm just going to highlight the factual things that Money Owl's product and ours may differ in. One is that obviously we highlight the fact that we are a multi-manager approach. So for Money Owl's investment, it's a single fund manager, Fullerton, great fund manager, and a partner of ours, but it's a single fund manager model versus our multi-manager model. The second thing is that they have these three different approaches. One is grow your capital with no payout. I think they have a 4.5% target payout. Again, these are all targets, right? They're not fixed or guaranteed. Our numbers are targets. When Money Owl's Wise Income also targets, and they properly disclose that. I'm certain, and we do too. That target payout is about 4.5%. And that's a regular income product and similar to our stable income because we target 4 to 5%. And then the third part is I think they have a higher payout, 8%, but that comes out of your own capital. So in effect, you put in the money and you're getting a higher payout, but you're paying it yourself. So it's not from the investment growing and then you getting payout. as Yulin explained earlier, but you're actually putting money in and then drawing down your money with a 8% higher payout. So fundamentally very different, because our three portfolios that target different returns are achieving it by trying not to take from the capital, preserving that capital, growing that capital over time, and taking more risk, or investing in differentiated products that are able to generate higher yield. So fundamentally different in the sense that the three products that we have, as we have shown, are different in terms of the fund compositions, the multi-managers that we use, in the risk appetite, the asset allocation is all changed. Money House product is 100% the same product, same asset allocation, same funds, same underlying assets, same everything. They're just adjusting the payout ratio from the same fund. So please go to their website, because I'm sure they have a wealth of information. Please come to our website to look at the income portfolios. We've been as transparent as we can with this income webinar today. We have a detailed income portfolio related insights article. Many people complain, but we've tried to put in as much as information so that you can be informed and educate and make an informed decision on which is the most suitable for you. And we have an in-depth income article even after that. So we have 2 articles, we have a webinar, and we'll be having, just as an announcement, in 2 weeks' time after Chinese New Year, another webinar with our fund management partners. So 4 of our fund management partners will be joining us. If we can just have the slides back up, I think we can just, yeah. So we have the fixed income investing webinar with AllianceBernstein, Neuberger Berman, PIMCO, and is that Fidelity, joining us for this fixed income investing webinar on the 9th of February. And then we have one on equities, so dividend investing equities, JP Morgan, it's hidden by this logo. So what is this one? Mention BlackRock. Yes, sorry. JP Morgan, Aberdeen, BlackRock, and First Sentier, First State. So all of these like wonderful fund managers will be joining us on 2 more sessions. You're gonna get sick of seeing me and Yulin by the end of this, but we are the leads in charge of building this portfolio, so we're in this together. And we'll be doing these additional webinars to provide you with as much information, and also talk about fixed income markets and equity markets and outlooks in general. But these are our fund management partners for our income portfolios that will be joining us for these sessions. So please join us, sign up and join us for these sessions, where you'll be able to find out much, much more. And obviously try out on our landing page and our website, where we have transparent details of historical performance. As you're on board, you can see all the transparent costs and fees involved, as well as the simulations for future outcomes as well. Tom has asked many questions. Some of them have been answered by our client advisors, but his question is, 10 years a long time. How do you select which stocks to invest in your portfolio? It also goes to some of the other questions, like why are you recommending income funds in such an interest rate environment? And other questions about underlying holdings of fixed income or equities. Do you rebalance? So the fundamental premise here is we are approaching this as a multi-manager fund of funds kind of structure. So we are working with fund management partners who are experts in their field in investing in income, fixed income, dividends, equities, real assets. So we pick the best of the best, and we are allocating assets and money to these fund managers to manage for you in the best way possible. So these guys have track record. They already manage billions of dollars in assets. They're the experts in investing, picking underlying stocks or underlying securities in fixed income or underlying assets, real estate or infrastructure investments or commodities in certain cases. And they're building portfolios. So Endowus is choosing and delivering on the due diligence process to select the best fund managers, select the best funds, and optimizing and building portfolios that have low correlation, high risk adjusted returns, and low fees. So that's the work we do as advisors working with fund managers. And we hope these portfolios will be able to generate good returns with high and stable current payouts. Yulin, anything that you want to answer in the question section? You can just jump in at any time. We'll
Yeah,
our
I was
advisor has answered many of them, but we'll elaborate on any that we need to. Yulin.
Yeah, I was reading through the comments, and I see that there are several questions on the fees, and also like the whether the performance numbers and also the projection that we have shown is inclusive of the fund level fee, the Endowus trailer fees, and the trailer fees and Endowus platform fees. So just want to clarify that all the numbers, all the performance numbers that we have shown already takes into account the fund level fee, but it doesn't take into account trailer fees. So actually, by right, you should be adding the trailer fees back to the performance numbers. And it also doesn't take into account the platform fee because it's dependent on the amount of assets that investors put with us. So by right, you should actually adjust it if you want to see, like the overall picture, the trailer fees and the platform fee that you will be charged. Hopefully that clarifies.
Okay. There is one other caveat that I wanted to highlight, which is some questions about, flexibility, investment amounts, etc. There is a minimum investment amount, which is $10,000 for the income portfolios. For the rest of our portfolios, the minimum is $1,000. And then after that, incremental minimum investments is $100. The reason is because we have a multi-manager, multi-portfolio, and when we invest it, there's a minimum sum. Otherwise, there's a cost involved, and we don't want to charge investors any more than we need to. So there's a $10,000 minimum for income and a $1,000 minimum for any other portfolio. And then incrementally, once you set up the goal, you can add increments of $100 to invest in them. But some questions were asked, like income funds and products have breakup costs, early redemption cost, or surrender cost and surrender values. These are investments that have no lockup. There's no additional cost, there's no penalty. You can put it in today, redeem it tomorrow. Obviously, it's unit trust based, and so there is a cycle that we need to go through. So there's a transaction period, maybe a few days to completely settle and get your money into your account. But other than that, there's no hold up, there's no lockup. We don't hold you to having to invest in any period of time. But I would caveat that by saying that if you want to optimize for returns and the payout that you want to receive, then you don't want to be trading in and out of income portfolios. You want to hold on to it for the long term so that the current payout is sustained, and you don't trade it through volatility, because there's always going to be volatility in markets, whether it's equities or fixed income. And you don't want to have to time that at any point in time and invest when markets are down, or take it out when markets are down. So I would suggest that if you are investing in income portfolios, that you try to think a little bit more long term, plan your strategy out so that you're not forced to react to markets in any way. So roughly 0.25% in fees compared to banks, but then pay 0.5%. So doesn't it end up being more expensive? No. The fees that we showed you earlier was almost a 0.57% or 0.58% fee. So meaningfully more than any Endowus access fees that are being charged. So net, it's definitely cheaper at Endowus at the total level, or at the individual fund level. But what's more important is that if you go to a bank and buy this portfolio or fund, then obviously it's, they're not providing advice, they're not building a seamless experience, they're not providing you with this optimized portfolio, they're not providing you with a rebalancing. The technology, the research, all the content, and even this webinar, we're providing all of this to you so that you can invest in these income portfolios. So the additional value add, I hope, that Endowus provides is meaningful at a lower cost than if you would do it at a bank or a fund platform elsewhere. So hopefully that cost saving is meaningful enough, and also that there's much more value add from us versus other platforms.
Yeah, and I also saw some questions on the underlying holdings. So there are questions on the dividend stocks that the portfolio investing, and also whether the holdings of the equities are fixed, do we rebalance the holdings over time? So I think there are two layers of that. The first is on the fund manager level. The fund manager is constantly in the market selecting different dividend stocks that is suitable for the strategy, and they will rebalance their portfolio to realize the investment objective of the fund. And another level is on the Endowus level. So we are constantly assessing the fund managers and seeing that whether they are doing the right things or whether there's any alarming activities or dissatisfactory outcomes. And if that is the case, or if we actually find cheaper options or even other value adding funds, then we will probably also do recommended portfolio changes. And on a portfolio level, we always do automatic rebalancing. So if we allocate, say, 20% to this fund and 20% to another fund, and over time, because of the different performances of the different funds, the weight will diverge. And once that divergence reaches the 15% threshold, we will rebalance it back to the original allocation. So if it's 20% allocation, 15% drift is about 3%. So once it drifts by about 3%, for this fund, we will rebalance the entire portfolio for you. And you can opt out that automatic rebalancing, but this is actually a value-adding service that Endowus provides for all of our customers free of charge.
Great. And there's one more question about why did not Endowus consider low-cost ETFs in the portfolio? Was it being compared with the mutual funds and determined that the funds are better? The bottom line is that, let me explain for many that may be a bit confused about the structures of funds. So ETFs are exchange-traded funds. And when they say it's exchange-traded funds, they mean an open-ended mutual fund, which are commonly called unit trusts. So they're listed unit trusts. That's what ETFs are. Whereas unit trusts, as we call them, are open-ended mutual funds that are unlisted. So you can actually have the same exact unit trust, a passive, let's say a Vanguard passive index fund, and have it unlisted as a unit trust or mutual fund, and also have it listed as an ETF, is listed unit trust or a listed mutual fund. So the two funds don't have to be completely different. I think many people confuse ETFs as being passive or as index. Yes, there are ETFs which are passive and index, but there are also unit trusts which are passive and index. There's also a lot of ETFs that are active. There's also a lot of ETFs that are very costly and not cheap. And the fundamental reason ETFs are attractive is because it should be low cost, it's tradable intraday and liquid. But unfortunately, this is mostly true in developed markets like the US, where there's a huge market and a lot of ETFs. There are now more ETFs than number of stocks in the world. So people are trading ETFs like stocks now, which is not what it was intended to be. Jack Bogle, the founder of Vanguard, the father of passive index fund investing, and you have to understand Vanguard's most popular passive index funds are all unit trusts and mutual funds in the US. They also have ETFs, but closer to his death, he said that if he had realized what ETFs would have become, he regrets Vanguard creating ETFs, because people are using it to trade in and out of the market and stuff that he didn't envision them to do. Now, in Singapore, there are not too many good ETFs listed locally here in SGX in Sing dollars. So even the good ones, some of the global ones are listed, but it's in US dollars. So inherently, there are costs involved because there are, FX costs involved in translating. There's also bid-ask spread. So because of lack of liquidity, there's like a 1% spread if you need to buy and sell ETFs in the market. But also many people use US listed ETFs, and it's great. It looks cheaper and it's liquid. But again, it has FX cost embedded. It also has withholding tax. So 30% withholding tax on an S&P 500 index, let's say dividend yield of 2%, you're getting hit a 30% of that, which is 0.6% or 60 basis points. So using overseas US listed ETFs in particular is very, very expensive. And many ETFs are not 10 basis points, 0.1%, it's 0.7%, more expensive than some mutual funds. And definitely more expensive than many of the institutional funds that Endowus uses. So what we decided was we need to use unit trust, but we can remove the cost that is embedded into the retail share class and access the institutional share class or the clean share class. Or if we have to access the retail share class, we get the rebate and rebate it all back to the client and achieve a lower net fee. So overall, our portfolio cannot be replicated with an ETF because many of these income dividend portfolios are not available. Secondly, the cost that we're able to achieve is the lowest possible in the market right now. And more than anything else, on top of that, we have worked in optimizing the portfolio and designed it in the right way to achieve the outcome. So the unit trust or mutual funds that we're using is a much better way than using ETFs, and there are not any good low-cost options here in Singapore. With that, I think we need to wrap up. But Yulin, if there's any questions that you want to answer before we go.
Yeah, I just want to briefly touch upon, I think, investors' concern on investing in this rising interest rate environment. And also, I think some are asking about the China exposure of the income portfolios. I think for the first question, we don't have enough time to address it now, but if you have time, we have this webinar with the fixed income managers next week. And this is a topic,
in 2 weeks.
In 2 weeks' time. Yeah, next week is Chinese New Year. And happy Chinese New Year, everyone, in advance. So after Chinese New Year, if you have time, come back and watch the fixed income webinar. And this is a key topic that we will address. And in terms of the China exposure, we will come back with more detailed numbers. But I have to say, I just looked up on the fact sheets of the two funds that have exposure to China. That's Fidelity and Neuberger Berman. And to the property sector, it's really low. So for Fidelity Asian Bond Fund, the current exposure to China property is only 7%. And with, a 20% allocation to the fund in our stable income portfolio, the allocation overall is only about 1.5%. But we will come back with more details on that. Just want to acknowledge that we have seen the question and we will address it.
Wonderful. And again, I apologize, we can't answer all the calls. We always get complaints that our webinars are too long, so we've already gone way past our planned time. But if you show the slides again, sorry, we have two wonderful, obviously, webinars that are coming up for those that might have missed it. As Yulin highlighted, in 2 weeks' time, we have the fixed income webinar where all of your questions will be answered by experts from AllianceBernstein, Fidelity, Neuberger Berman, and PIMCO. And then the week after, 2 weeks later, we'll have the equity session with JP Morgan Asset Management, Aberdeen, BlackRock, and First Sentier Investors. Wonderful partners who have worked with us to build the best income portfolios that we can build. So please check out the landing page, the accounts. Reach out to support@endowus.com if you have any follow-up questions or concerns about or questions about how to onboard or create portfolios on our platform. With that, Yulin, would you like to say goodbye?
Yeah, thank you all for joining us today, and even over time. Thank you for your time tonight.
Thank you so much, everybody. Have a wonderful evening. We'll also have a QR code, which is a new effort from our marketing team. If you can scan the QR code, you can go directly into the deep dive insights article on Endowus Income Portfolios. There's also a launch article on Endowus Income Portfolios so that you can look at both articles in there. We have a lot of wealth of content that's available as well. So please check out the Endowus Insights website. With that, I want to thank you so much. Have a wonderful evening. We won't see you for 2 weeks in the webinar, so Gong Xi Fa Chai, and have a wonderful Chinese New Year with your loved ones and family. Please take care and be healthy as well. Thank you.
Thank you, everyone.